Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, just to go to our first guest here, Robert Teeter. He's the Chief Investment Strategist, Silvercrest Asset Management. He joins us here in our Bloomberg Interactive Broker Studio. So he gets a double gold star for coming in on
bright and early.
Yeah, exactly. Robert, again, Jess was just mentioning the lack of participation maybe in this marketplace. When you look at the S&P up 26%, the S&P equal weighted index up 12, 13, 14%. So a big divergence there. Is that a concern for you?
It is a bit of a concern. I think most of it is tied to moves in interest rates, in my view. We've had a lot of these head fakes where you've had enthusiasm over rates coming down more quickly. That's led to a broadening out of markets. And once again, we've had that rug pulled out from under us with, rate expectations for next year now being dialed back pretty significantly, and with the 10-year heading higher. And as the rate on the 10-year heads higher, people get more and more concerned about smaller companies, and you have that narrowing of the market where the winners keep winning and the laggards keep lagging by quite a bit. The tide could turn for 2025, but that's been the strongest relationship that we've seen for that. The relationship between large and small has been where rates are and where they're headed.
So how are you advising clients to position going into next year?
We're pretty enthusiastic about small caps for next year.
Really?
One of the key reasons is the M&A backdrop. It
has
been a long time not working. Yes, but we do see a couple of new catalysts, and those are really with the change in Washington. So
okay.
M&A backdrop, that was a very slow environment for most of 2024. Everything we're hearing is that the backlog of deal activity is picking up. People are pretty enthusiastic. That tends to accrue to small caps. They tend to be the acquisition target, and that gets you a premium there, and that helps a bit. We think the broadening out will continue slowly as rates head slowly lower over the course of 2025. I'll probably say slowly 3 or 4 times, but we do think that's headed lower. That alleviates a little pressure as well. And then lastly, we see some of this profit margin expansion that's been mainly in large caps broadening out to the small cap space as well. Of course, there are a lot of non-earners in indices like the Russell 2000, but we do think there's potential for profit margin gain as AI and productivity spreads to a broader segment of the market.
I just pulled up in my G where I have a lot of my charts saved. It's the Russell 2000 relative to the S&P 500 year to date. So if you look at this year, it's underperforming the S&P 500 by 14 percentage points. So that would be the worst underperformance since actually 1998, and the 4th consecutive year in a row that the Russell 2000's underperformed the S&P 500. So when you look at an index like that versus the S&P 600, better earnings potential in the 600 obviously than the 2000 because of the zombie companies in the 2000. Which way do you play that?
Yeah, absolutely towards the S&P 600, the earners. Sometimes when you get these quick turns, it accrues to the whole index, and some of the quote unquote garbage rallies faster. But I think for the full 2025, the reason we're enthusiastic about small caps, it is the higher quality, profitable companies in small cap narrowing the gap against their large cap competitors.
Which ones do you think are more competitive and more profitable in particular industries?
Yeah, I think it's really a stock by stock situation, not only in small cap, but in large cap as well. So our view has been that the driver going forward will be less from the economic side, less from the multiple side, and more from the earnings growth side. And the earnings growth side we see really coming from profit margins rather than the top line. And so it's just this case-by-case implementation of technology-enabled efficiencies, boosting margins, and that can come in any industry or any company at any time. So it's a harder market. We think it is one that lends itself more to stock selection, understanding management teams, understanding how the environment might shift from the creators of AI to the users of AI, and those users of AI really deploying in an effective way to boost margins.
What are we doing in the bond market here? I can sit there in a 2-year treasury and get 4.33%. I don't have to be a hero. Do I take some credit risk here?
We have not been big fans of credit risk. You're absolutely right. You get a pretty good yield without taking on that illiquidity premium or in private and the credit risk premium in the credit space. So we've been pretty cautious there. We've missed out. Obviously, those are areas that have done quite well, but pretty easy to sit at the short end of the curve and get close to 5% and be pretty content there.
So when people want to talk about, especially the annual gains in the S&P 500 being up once again more than 20% this year, second consecutive year in a row, and the first time we've seen that since the late 1990s, how are you thinking next year can shape out, and can that continue to where we'll still have double-digit, maybe even more than 20% again for potentially a third consecutive year in a row?
I see that as a pretty low probability. So our base case is really 9% gains, just tracking earnings higher, holding multiples where they are. Street consensus is more like 15%, 14% earnings. We're at about 9%. You could see a case where enthusiasm builds. We've got pretty high multiples here. Most of the 2024 gain, about 2/3 of it has come from multiple expansion. So we think we've kind of pulled forward some gains. Unlikely to see that happen, but you could always push higher to those 90s type of multiples. I think that's unlikely. And the big key for us is really the economy. If there's no recession, we think that earnings backdrop holds and the gains continue, but only at the high single-digit level, not much more than that.
Why do you think? I mean, the street. I think one of the risks, perhaps in the market in 2025, is the earnings risk, because I think I've got a Fed. It's going to cut maybe a couple times. So that's not really going to be a catalyst for me. Earnings really have to come through for this market to move higher. And again, 13, 14, 15% earnings growth, which seems to be dialed into street consensus, that seems pretty. I'm not going to say aggressive, but boy, that's a heavy lift, I would think.
I think it's a heavy lift as well, especially when you look through at a sector level. Some of the cyclical sectors are expected to see pretty high earnings gains. I'm not sure how that happens unless the economy reaccelerates, and I don't see that happening. Certainly don't see a recession, but if you're tracking along at 2.5% GDP, I'm not sure how you get an acceleration in some of the cyclical space. So that's one reason we're a bit more conservative on the earnings front than street consensus.
We only have about 30 seconds left, but what's the top advice you'd give your clients going into 2025?
Yeah, I think it's stay the course. Paul was mentioning about the long-term compounding effect, and I think really stay the course here. There's no immediate big recession. There's no giant imbalance in markets right now. Economy looks okay. Earnings look okay. Just keep compounding that earnings growth going forward.
That's the message I give to my kids, 3 of whom are in the working force. Max your 401k.
That's right, yeah.
And I think they're doing it, and I think that's going to be
I hope so.
A good thing. Robert Teeter, thank you so much for joining us. Robert Teeter, Chief Investment Strategist, Silvercrest Asset Management, joining us here in studio on Friday, December 27th. I mean, who does
Brownie
that?
points.
Exactly. I mean, definitely. So we appreciate that.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
I don't know, as long as I can remember, and you probably know this better than me, but it just seems like tech has been leading this market forever. And I can't imagine a market where tech does not lead. I mean, it doesn't lead us higher.
All the different acronyms. We've gone from FANGs to Mag 7s. Now people want to call it Batman if you throw in Broadcom.
Big data. Now it's AI. Now our next guest has been on top of all this. Melissa Otto, head of TMT Research at S&P Global Visible Alpha, joins us here in our studio. Melissa, what is your call on, what are some of your top picks in global tech? Because again, it feels like if this market's going to move higher, another leg higher after 20+ years in performance, technology's got to lead us yet again. Do you think technology can lead this market yet again?
Good morning. Happy holidays. 2025, here we come.
Yep.
I think there are a couple of trends that we're really looking at for 2025. First and foremost, are we going to start to see an upgrade cycle? We were looking for that this year. It didn't really pan out. Apple and Dell look very well positioned to benefit from an upgrade cycle. Based on Visible Alpha consensus, we're seeing that analysts haven't really taken their numbers up for an upgrade cycle, but if we do start to see a catalyst there, that would be an interesting theme. Enterprises coming in and saying, okay, we need to upgrade our employees' laptops, our employees' iPhones, and we saw that in mass in COVID. And so, we haven't really seen that cycle kick in yet. So over the next, say, 6 to 18 months, that could potentially be a window where that kicks into gear and would be positive.
It's interesting looking at Apple specifically because the stock's up about 35% year to date. And if you think back to the first quarter of this year, that was one of its worst underperformances relative to the S&P 500 since the dot-com bubble bursting there. But since it made a bottom in the middle of April, it's just continued to take off and defied a lot of those expectations. Obviously, in early May, it announced that another historic buyback program that it still needs to execute a lot of that on. But when you're thinking about more the fundamentals versus the technicals, where do you think this is pointing in the direction when you have other stocks like NVIDIA and very different type of chip company, but when you're thinking about how to position into that next year?
Indeed, we're in an interesting point with Apple. They were a bit late to the game around the whole AI theme. They came out in June at WWDC and revealed their Apple Intelligence, and the market got very excited about that. It drove some upside in the stock, and then it sort of petered out. And I think we're coming into 2025 potentially with this upgrade cycle in mind, and the idea that AI may start to drive more of an enterprise adoption, and that enterprise adoption could potentially lead us into a broader adoption. And I think that's what the market is. That there's some market consensus around that theme. There's still a lot of debate, though.
AI. How much are you buying into this AI thing? I mean, everybody's telling me, Gene Munster, he put it in the context of it's bigger than the internet potentially. How do you think about it? How does that factor into your thematic research, AI?
The challenge with AI is that in building AI applications, so we've seen, and to your point, we've seen a lot of innovation in the chip and in the model. Where the challenge is in the application layer. And part of the reason for that is that the application layer requires deep domain expertise. And in order to have the application really resonate with the user and really be useful to us, it requires a high degree of accuracy. And I think that's where it's becoming challenging, is that when you have an agent or you have some sort of generative AI bot or tool, it's not as smooth or as streamlined or as accurate sometimes as the user needs it to be. And so I think that's where you're getting some pushback, particularly in enterprises, where companies are saying, hey, if we're going to have our salespeople, if we're going to have marketing, if we're going to have the business side really leveraging this, it needs to be very high quality. And I think that's where, if you're looking for a hotel, for example, and it's a little bit off, that's one thing. But if you're having it write an email for a customer, that's a different thing. So I think having the domain expertise in the application layer is probably making it a bit slower than the market had initially expected.
So, Paul, what do you think is the best performing stock in the S&P 500 this year? Because there's one stock that comes to mind. So you would think it was. It's actually, it was for most of the year. It's Vistra. Actually, so it's the power producers that are tied to the AI play in utilities. So actually that stock's up, if you look at that VST is actually the ticker symbol on this, up 274%. So when it comes to more of the data center type plays, I'm wondering, what's your view on that when it's beyond even just what you think of the cohort of the Mag 7, if you're thinking about those sort of data center plays that people are investing in? Because NVIDIA actually up 183% year to date.
Right. Yeah. I mean, S&P Global 451 Research has done a lot of work on the energy side of it, and Vistra fits right into that with the potential merger of Energy Harbor. They are likely to really benefit from the AI data center energy consumption. I mean, the reality is that all this computation and the velocity of power that is required for a data center is going to increase.
Real quick, 30 seconds, Microsoft. What's your call there?
Microsoft's interesting. They recast their accounting lines. They now have an AI services line. And what's amazing about that is that we can start to really see how AI is dropping into their P&L. And Microsoft last year did about $4 billion in that line, and then based on Visible Alpha consensus, that's going to $18 billion by fiscal year 26. So some real acceleration there.
Yeah, it's just been extraordinary here. So I guess my takeaway is AI is like a thing, and it's impacting a lot of companies, and we're going to be talking about it more and more and more. But I remember just a couple of quarters ago, every company in the S&P 500 talked about
the
AI
earnings
in the
calls.
conference calls.
Right. And Kroger was one of them, too.
Yeah, I mean, McDonald's, I don't know. Melissa Otto, thank you so much for joining us. Melissa Otto, she's head of TMT Research, S&P Global Visible Alpha, joining us here in our Bloomberg Interactive Brokers studio.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Jennifer Lee joins us. She's a senior economist. She's a managing director at BMO Capital Markets. Jennifer, as we think about 2025, I'm not even sure where to start. I mean, let's just start. We've got a new administration coming in the United States. We've got a new Congress about to be seated in the new year. What do you expect from, again, the new sheriff in town from an economic perspective? I don't know if it's, tax policy, if it's tariffs, if it's, changes in immigration policy. There's a lot of moving parts. How does that impact your outlook for this U.S. economy?
Well, good morning. Happy holidays to you both, and thank you very much for having me on. This is it's that key word, uncertainty. Expect the unexpected. There is so much unknowns as we're heading into the new year with the new Trump administration. He's already talked about what he plans to do, everything that he wants to do on his to-do list. Whether or not he's going to be checking them all off on day one, that will be very interesting to see. But certainly, tariffs is the key measure that he's planning to roll out. He's already talking about the 20% blanket tariff on all $3 trillion worth of goods coming into the U.S., and that will be already significant compared to what he did back in 2017, which was, targeted tariffs on about $300 billion worth of goods. So this is a bigger impact. And of course, 25% tariffs on Canada and Mexico, an extra 10% on China. Maybe this is on top of the 60%, so I'm not sure what the figure is going to be. So there's a lot of uncertainty, I think, heading into this new year. But tariffs are certainly the key factor. Taxes, corporate tax cuts, targeted tax cuts, I think, which would be great for corporate America. And of course, different tax relief measures for those who are earning overtime, Social Security, and of course all those other issues like the biggest deportation effort ever in the U.S. Cleaning out all the extra stuff that doesn't need to be spent. That's where DOGE comes in. So a lot of things on his to-do list, but how that's going to play out remains to be seen. And I think this is why we're expecting a lot of uncertainty as we start the new year.
The latest estimate for the Atlanta Fed's GDP Now model for the current fourth quarter, actually above 3%, Paul. Mm-hmm. And of course, we were talking about earlier the economic growth projections. If you look at the ECFC function in the terminal, that can pull it up for you on a quarterly as well as an annual basis. So, Jennifer, I'm curious because year after year, especially coming out of COVID, there's so much doom and gloom, even for the expectations in 2023, 2024, that a lot of economists ended up being on the wrong side of that and getting it wrong. So what are people getting wrong about next year? Because I feel like once we wrap up a year and look ahead, we always have these kind of anticipations that never quite come to fruition when you look a year out.
That is true, and we have been, I think, on too low on our growth expectations. We were never in the recession camp, thankfully, but I think everyone was always too low on their growth expectations. We've got about 2.25%, just under 2.5% penciled in for next year. Where I think the miss has been is certainly from the U.S. consumer. The U.S. consumer continues to be the big driving force of the broader U.S. economy. That, and of course, over the past few years was all the business investment and government spending as well, helped with the CHIPS Act and the IRA. That certainly helped boost the economy. But the U.S. consumer continues to surprise And we should always say never, ever underestimate the U.S. consumer. Just the last November data for personal income and spending showed continuing spending. It wasn't exactly super strong, but it was still they were still spending. And also in those areas that if things were really tough, we wouldn't be spending on, like recreational goods and services, recreational vehicles, that area. There was a bit of a pullback on dining out, hotel stays, but overall still decent consumer spending, still decent consumer wages. Savings rate just over 4% is still pretty decent as well. So I think that's where the mistake has been. So we'll have to see how things go in the coming year, just given that we are expecting inflation to tick higher.
So the dollar just in this last 3 months is up, nearly 7%. And for the Tom Keenes of the world that like to, vacation over in Rome or Paris or London, it's a good thing. What do you make of this strong dollar, Jennifer?
So the strong dollar has been, at the beginning, it was a function, I think, of the stronger U.S. economy. Like throughout 2024, the mistake has, I think everyone has already underestimated, I think, global growth as well. I don't think there was one G7 country that had back-to-back negative GDP readings. So nobody was in an official recession. Things got revised a lot, which I thought was very interesting. It's just on the data front. But everyone ended up stronger, I think, than expected, especially in the U.S. So a lot of that U.S. dollar strength was reflection of much stronger U.S. strength relative to everyone else. And now, over the last few months, it's been a reflection of, Fed expectations, at least over the last few weeks in particular, just given how everyone's expecting the Fed to not cut as quickly as originally had been anticipated, just given, again, incoming tariffs, potential impact on inflation. And now with the last dot plot showing only 50 basis points of rate cuts penciled in, which, by the way, I think we sort of have to take with a grain of salt, that certainly put a little new fire underneath the greenback. And that's been very, very difficult to make good calls on the currency market, just given all this volatility. So the Fed not cutting as quickly or as much, everyone else seeming to face slower growth as we're entering the new year and more rate cuts coming, like from the ECB, from the Bank of England, maybe not the Bank of Japan. The RBA is probably going to start cutting rates in February. That is going to also weaken their currencies and put more strength underneath the U.S. dollar.
I'm curious, as the calendar flips to 2025, the Fed, of course, will have new voters. Who are you keeping a close eye on for as we get closer to what people are arguing debatably, that neutral rate? Who do you think is more of a close call on dissents here?
Well, you know what? I think I'm going to go back to just to see what I think Fed Chair Powell is going to be the key Fed policy maker, of course, that makes the key decisions. And whatever he says sort of reflects, I think, the broader consensus. So I think I'm going to keep listening to what the Fed chair says. I mean, everyone else has their own opinion. Everyone has their own dots. But I think ultimately it's going to be up to the Fed chair to make that deciding factor. So I'm just going to go straight to the boss and say it's going to be Fed Chair Powell.
Jennifer, you're up there in Toronto. How are our good friends in Canada thinking about this new administration, maybe some tariffs? Because last I checked, we do a lot of trading with you guys up there.
Yes, the U.S. is our biggest trading partner. 75% of our exports head down to the U.S. So obviously, we were already pretty nervous because the USMCA is up for renegotiation in May of 2026. So we already knew that there was something going on that front. And now with the new threats of a 25% tariff on both of the U.S.'s trading partners from that deal, from both Mexico and Canada, obviously makes us very nervous. And we're going to have to see if we are going to be able to do some, decent negotiations that will hopefully, soften the blow, and hopefully we won't see this play out. Even if it's also going to depend on how long, if he does do what he threatens, which is the 25% tariff on Canadian imports, how long that's going to stick around for. And, hopefully it's not going to come to fruition, but there will be very bad news for our Canadian economy. But we've got about 2% penciled in for Canadian GDP growth this year, or for next year at least. Rate cuts have had a good impact, but all that could be erased if we do see a blanket 25% tariff on all Canadian imports.
All right, we'll stay on top of that for everyone. Jennifer Lee, Senior Economist, Managing Director at BMO Capital Markets. We appreciate getting some of your time.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
I don't know, holiday shopping done. feels like I spent about the same. What do you think you did? More or less the same?
I spent a lot on Black Friday and Cyber Monday.
You did.
I'm not gonna lie.
You were in.
That's where I did all the.
You did the damage.
The damage was done.
The damage was done. All right, let's see how this thing's kind of shaping out here as we kind of get a little bit of a look back here. Julie Van Ullen, Chief Revenue Officer, Rakuten, joins us. Julie, here we are here on December 27th. Any early sense of how that holiday shopping kind of panned out in dollar cents?
Yeah, absolutely. First of all, thanks for having me again. This was an interesting holiday, as the whole year has been. It has been pivots after pivots looking at consumer behavior. And what we saw this cyber was the developing behavior of a very uncertain consumer, I will say. We monitored daily shopping pre-Black Friday and throughout main cyber shopping days. And what we saw is shoppers came out very early this year. They were really looking for the deal and not the day. But we had done some research with Harris Poll earlier this year, and we knew that retailers were highly confident that they were going to be able to drive all of their sales during peak moments like Black Friday and Cyber Monday. And I think, unfortunately, many of those retailers who took that tact missed out on a lot of this pull forward of early shopper demand in moments where they feel uncertain and are really willing to pull the trigger when they get enough of an incentive to buy. And we also saw them buying with much more specific intent. I heard you both say that either you shop the same or perhaps a little bit more on those key days. And what we saw was something similar, but much less browsing. So consumers were very clear about what they wanted to buy, and they came to the sites, they purchased in a very purposeful way at a very high average order value per trip, meaning that they were ready, they knew what they wanted, and when they got that incentive that they needed, they bought.
What were consumers buying more or less of?
That's actually one of the most interesting trends of this year that's certainly new to me, having been in this space for a long time, where leading up to Black Friday, we saw a trend that I started calling first me, then you, which was to say that consumers were buying from very non-traditional gift-giving categories. Think things like pet care or personal banking. And as Black Friday hit and we're monitoring trends, we continued to see that behavior happen. And we kept waiting for it to shift to more traditional gift giving. And fundamentally, it just kind of didn't. And it wasn't until after Prime holiday shopping, after Cyber Monday, really, that the last minute shopping started to move back toward normal gift-giving categories like gift cards, toys and games, sports and outdoors. But really fascinating, and I think continues that trend of an uncertain consumer who's using moments that they know that they're going to get the most value to shore up themselves and their families before they started to think about gift giving.
Julie, how promotional were the retailers this season? What did they have to do to get people kind of in the door or clicking that mouse?
They knew that it was going to be a season of value-seeking consumers. It was no secret to anyone. So it was very much a season of stacking and using whatever lever brands could, whether that's their own in-house deals and promotions, whether that's things like free shipping, buy online, pick up in store deals as we got closer to holiday shipping cutoffs, and also, of course, other levers that will drive permission to buy, things like cash back, especially for brands who maybe don't want to do as much discounting. We saw a lot of that happening in the luxury space in particular, but it was really whatever lever a brand or retailer could use in order to be competitive in a market where they knew that consumers were going to be much more loyal to the deal than to the brand, which is exactly what happened.
Now that we're past the Christmas holiday, what other promotions could we see at the end of this year and going into January?
Well, of course, at the end of the year, you're always going to continue to see brands offering deals to offload any gluts of inventory that they may have. We had a lot of interesting shipping moments leading up to Cyber Week this year. So you'll see those deals continue through the end of the year. for certain, but what I predict going into 2025 is really that we're going to continue to see this developing habit of a very uncertain consumer and retailers trying to meet them in that space, which means that the deals and incentives can't stop. However, brands and retailers need to figure out what works for them in order to give shoppers the most bang for their buck. And one of the interesting trends we started to see even in Black Friday and Cyber Monday is this very delicate dance between direct-to-consumer brands and retailers, where brands were offering, in many cases, higher cash back than the retailers who carry them, because that's a lever that they have. They have potentially more margin on those products to offer to the value-seeking consumer. And the retailer has other levers, perhaps things like free shipping that they have an ability to offer with better infrastructure to consumers. So it's really going to be this dance to meet the consumer where they are as they continue to focus on things like everyday items and essentials.
Julie, the pandemic, it seemed to bring forward by several years the percentage of market share for e-commerce versus bricks and mortar, and e-commerce really grew. Where's that relationship now, e-commerce versus bricks and mortar for most retailers?
E-commerce did grow, leaps and bounds. We took what we saw about like a 5-year leap into the future in terms of e-commerce growth, and it really does continue, but we are seeing a dramatic increase this year in terms of in-store behavior. Rakuten has ability to give cash back in store as well, so we monitor these trends. And that piece of our business has been one of the most dramatic areas of growth year over year. And I think we're going to continue to see that into next year, especially with that very highly coveted next generation Gen Z shopper continuing to grow and bring strength to the market. They prefer a very tactile shopping experience, worried about quality and sustainability. So I think that we're going to continue to see that trend move more toward brick and mortar next year. But again, that doesn't change the fact that this is still a value-seeking consumer. So in-store retailers are going to need to find those incentives to continue to drive shopping in store.
All right, Julie, thank you so much for joining us. Always appreciate getting a few minutes of your time. Julie Van Ullen, she's the Chief Revenue Officer at Rakuten.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.